It's really an honor for me to be here today and to be part of this team that is working on Sri Lankan economics and trying to generate faster economic growth by emphasizing the diversification of exports and the promotion of foreign investment. Let me ask a question. How many of you have studied economics in the audience? How many of you have studied trade economics in the audience? Okay, so a lot of you are working in the trade area, but in fact have not really been exposed to a lot of economic thinking. And so what I'm going to do today is to try precisely to give you an introduction to some of the core ideas that economists bring to thinking about trade. And so those of you who are economists and those of you who have studied trade economics, I ask you to bear with me. But I hope I'm going to be able to show others of you who have not been exposed to trade economics a way to think about and a way to frame the policies in which you are currently engaged. And I thought I'd do that by dividing my presentation into two parts. In the first, I'm going to be talking about why might trade be beneficial, although I will also point to some of the costs of international trade. And in the second part, I'm going to be talking about why might one want to protect the economy. And so my purpose today is actually to give you those frameworks to think about these core issues. Why are we trying to trade a lot, on the one hand, and are there occasions when we might think about protection? So if you start off and you assume a country was isolated, and then you open the country to the world, what you'll notice is that the chances are certain goods are going to be cheap in that country and expensive in the world. And those are going to be goods that the country exports. On the other hand, there are going to be other goods when the country opens up to trade that are going to be relatively cheap in the rest of the world and relatively expensive in the country. Now, the country has an opportunity to trade. Is that a good or a bad thing? And who is going to win and who might lose if we open up a country to trade? That's what I want to think systematically about. You see, let's think about exporting. So what I just said was, there are going to be some products that have a low price. You know, if Sri Lanka couldn't export its tea, tea would be very cheap in Sri Lanka. So presumably, once we open up Sri Lanka to trade, Sri Lanka will start to export a lot of tea, and the price of tea is going to go up in Sri Lanka. Now, this is going to be very good, of course, for the exporters of Sri Lanka. They're going to make more money. But on the other hand, the consumers in Sri Lanka are now going to have to pay more for tea. So they're going to be winners, the producers of the product, and they're going to be losers. So immediately, if you think intuitively, you start to worry. Well, what if the consumers are hurt more than the producers gain? Conversely, if we were to think about importing, there are going to be some products that are, if Sri Lanka is in isolation, there are going to be some products which are relatively cheap in the rest of the world, but expensive in Sri Lanka. And so in that case, if you open up to trade, the prices of those products are going to fall. Now again, there are going to be winners and losers. On the one hand, there are going to be the consumers. They're going to be very happy. You know, maybe before they had to pay very, very high product prices for products, say machines, but now that they can import the machines, they've come down in price. Before they might have to pay a lot for oranges or other products that aren't grown here, but now they pay less. On the other hand, the producers are going to lose. So what we see is that trade is going to create winners and losers. But we start to worry because we are concerned maybe the losers will lose more than those who win will gain. And under those circumstances, trade would be harmful. So what we need is some way to work out who's going to gain and how much, and who's going to lose, and then we need to compare the gains to the winners with the losses to those who lose. Now, anyone who's studied economics, first class, what they'll show you is a demand curve. And they'll show you that there's this demand curve, and if the price is very high, well, then people will only want to buy a small amount, and there'll only be few people who want to buy the product. On the other hand, if the price is low, people will be willing to buy many more of the product. And then there's a group of suppliers, and for them, the relationship is the opposite. And if the price is very low, only a few will supply, but if the price is high, more of them will supply. And then, you know, the economists proudly put both the supply and demand curves together in order to explain how a price and a quantity are determined, at which the quantity people want to supply is equal to the quantity people will want to demand. So that's in a competitive market when there are lots of small, when no one can actually affect the price, we're going to get this particular outcome. Now, is this good? Is this a good outcome? The fact the market settles at that point, we ask ourselves, what are the properties of this? Is it good for the country as a whole that we have this particular set of prices and quantities? Well, again, in order to answer that question, we need to understand the benefits to the society as a whole. And the way economists have developed a technique in order to see this is to go through what's called consumer and producer surplus. So let me return back to this particular demand curve. Well, what we said was there's people up here, they're willing to pay a high price. There's people down there who are willing to pay a low price. Assume that the price in the market, once it's established, is P star, this particular price. Now think about the person along the demand curve up here. That person is going to be very, very happy because they were actually willing to pay a high price. But in the market, the price is lower. So we can actually say if they were willing to pay $10, but the price is only $1, they get $9 worth of surplus. And in fact, what we can see is that there's going to be a surplus which is enjoyed by the consumers. There's going to be another consumer willing to pay less, but still higher than the market price. And then there's going to be a consumer exactly at that margin who's indifferent. They don't get any benefits. That's exactly the price and the only price they're willing to pay. If we calculate this whole area, we can actually see all of the gains to the consumers. And similarly, basically, we can get the producers. There's a group of producers, each of whom are willing to supply at a different price. If the price in the market is P star, what we see is there's a producer who is willing to supply at a lower price, and so they get a premium. They will enjoy a surplus. And we can take the area between the price and the supply curve, and C, these are the gains to the producers. Now we have a mechanism to see benefits to each of the groups. Think back to the curve I showed you, the conventional picture of a supply and demand curve. And you'll see it has a very good property, because that point is the point at which these two triangles, the first being the consumer surplus and the second being the producer surplus, are the greatest. You can't find another combination of prices and quantities that actually give as much benefits as a result of producing and consuming this particular product. So it's a really good piece of news in the sense that the combination which is likely to result in a competitive market is precisely that which will maximize the benefits to the society as a whole, both to the consumers and to the producers. So that's Adam Smith. That's the invisible hand in which these parties achieve maximum benefits. Now, I just want to warn you that there are a lot of assumptions that you need in order to predict that this is actually going to happen. You do need to have all of the social costs and all of the social benefits reflected in the demand and the supply curve. So, for example, if this was the market for cigarettes, and all we had were the smokers in the demand, and we had the producers in the supply, we wouldn't get the full effect on society, because there might be the health problems that those smokers cause for all other people who are not involved in the market. So we need to be sure that everything that is relevant in terms of the social costs are actually represented in these private supply and demand curves. This is a very crucial point that I'm going to be developing in a moment, because it's going to turn out that if you want to argue there's something wrong with what happens in a free market, you need to base your argument on the idea that the prices that are being determined in the private market by only private actors is somehow wrong from a social standpoint. And that's what gives you a role for economic policy. But if the markets are actually competitive, if no buyer or seller has pricing power, then we're going to get an optimal outcome. Now, I've taken you on quite a large detour, but I want to return now with this analytical framework to look at international trade, to look again at the story of importing and exporting. So suppose this is the demand at home and the supply at home before we trade. And this is the world price of the product, and that's the price when we are isolated, when we are in autarky. Now, what we can see here illustrated is that if we open the market in this product, and it's a very standardized product, think about tea of a certain type. Well, what's going to happen when Sri Lanka is able to export is the price is going to go up at home. That's what we said. Now, is that a good or a bad thing? Well, look at this area over here, 1. 1 is an area which is between the price and the demand curve. So 1 is telling us something about who's being affected. Who's being affected in 1? Producers or consumers? It's going to be the consumers. The consumers are going to lose. And now we can actually see how much the consumers are going to lose. But let's think about what happens to the producers. Because the price is higher, the producers are going to increase their production up there to QP. And so there's going to be an area area 1 plus 2. And in fact, we can see that this whole area, these gains to the producers are much greater than the costs to the consumers. So, for a country, exporting is beneficial under competitive conditions because the gains to the producers are going to be greater than the losses to the consumers, as long as the supply and demand curves are shaped in the way that I have drawn them. So this is a great relief that the country as a whole is going to be made better off. And the central lesson is here, you want as high a price as you can get for your exports. Now, of course, there are winners and losers. And so we know, particularly when it comes to politics, that in this case, the consumers or the buyers might object to exporting. They'd rather keep the prices low at home. There are some people, for instance, who say, you know, it would be a good idea if we didn't allow the export of sapphires from Sri Lanka, because then the price would be cheaper, and those who use the sapphires, those who produce, who cut them, are going to benefit. So there are going to be those winners and losers we can see as a result of trade. But if the markets were competitive, the country as a whole will benefit as a result of opening up to trade. And when it comes to exporting, you want as high a price as you can get for those exports. Well, usually, actually, the debate is about imports. So let's look at that story. This is the demand for imports. This is the supply. The world price of an import is generally lower than the price at home. That's why the product is going to be imported. And we can see if we started off when the country was isolated, when the price was PA and the quantity produced was QA, two things are going to happen as the price falls. Firstly, the consumers are going to be able to buy more. There are going to be, the quantity available in the market is going to increase. On the other hand, the domestic producers are going to find that the competition has gotten much stronger and they're going to reduce their supply. Is this good for the country or bad for the country? Well, this is a picture which is a very long-run story. But let's have a look now. Let's have a look at the costs to the producers. It's going to be this area 1. What we see is the producers are now only going to get the price of the world price rather than the price when the country is isolated, and they're going to lose the area 1. What about the consumers? The consumers are going to gain the areas 1 plus 2. So, importing in this world is good. Not only is exporting good, but importing is good. And importing is good from a social standpoint because the gains to the consumers, this whole area, are much greater than the costs to the producers. If they wanted to, or if the government wanted to take some of the gains of the consumers, it could compensate the producers and the consumers would still be better off. And the society would still be better off. This triangle 2 gives us the gains to society from importing. So the central message under competitive conditions is that countries gain from trade. They gain from exporting and they gain from importing. And in fact, the lower the price of imports, the more the country is going to gain. And the higher the price of exports, the more the country is going to gain. Now, I want to emphasize, all these propositions I have just enunciated depend very much on the assumption the markets are perfect. And all of the relevant social considerations are taken account in this particular picture. Of course, we know for some period of time, if we were to open our economy, since we've reduced the amount of production here, there could be workers who work in this industry. And those workers will have to find other jobs. And we haven't shown the costs of them being unemployed in this picture. So there are going to be transitional costs involved in opening up to trade. But over time, once the economy is fully adjusted, and that's the picture I'm showing you, you can see there are gains from both importing and exporting. That explains kind of the enthusiasm for international trade, both importing and exporting. So that's the main message I wanted to elaborate upon. It's been quite complicated, but what I've tried to show you is you can actually measure the gains from trade, and you can actually see how, especially when it comes to imports, those consumers will gain and the producers will lose. This is economics. Of course, in politics, things feel a little different because producers, firstly, can organize much more easily than consumers. And secondly, it's also likely that you're going to have a lot of consumers. And so their gains could be quite small per person. Whereas the producers, for them, that's their job. And so they're going to be much more motivated to resist. So they're able to organize and they're able to resist. And so while the economics tells you you should be trying to drive in this direction, the politics, as I'm sure the minister would tell us, is somewhat more complicated than this picture will provide. But I'm giving it to you because ultimately we're trying to, hopefully, to make our society better off as a whole. Okay. Yes. Sure. Any responses to this particular framework? You have a notion, yeah, he's telling me, you know, we have a notion imports are bad and exports are good. And I'm coming along saying, no, imports are good and exports. You see, the reason is we don't even think about the consumers often. We ignore them, and they don't make us listen to them. And by the way, as I'm going to develop later, I've been talking about the consumers. But remember, actually, we're talking about buyers of imports. And a lot of the people who buy imports are not buying them for the final use in consumption, but they're buying them as inputs into making other products. And that's an idea I'm going to develop in a moment. Any other reactions to this? So you're all convinced? Oh, well, that was easy. Okay. Because you see, I think actually people look at trade quite fearfully. And yes. Please, let's listen. It's good to have a dialogue. Yeah.
When you mean by consumers, it is the consumers in that country.
In that country. I'm only talking about this country.
And the producers are also in that country.
Only in this country. I've shown you this whole picture. Yeah, it's only the people in the country. I'm taking a national viewpoint. And I'm saying this country, as a first approximation, would be much better off under complete free trade. Okay. Under the assumption that the prices are accurately reflecting the true social costs. Because when I turn to making a case to protect, I believe it has to rest on a belief that there's something wrong with the prices as they are currently being emerging in the marketplace, and therefore what we need to do is to improve on them. But if we've got no good reason to doubt that the prices are being distorted, this logic seems to be quite apparent. Now, as I say, it's fine for an economist to come and tell you all this. But if you confront people in the real world, you'll see there are deep fears about international trade. And I would characterize two as very common. If you go, most people think within a country, we should have free trade. If I came along and said, I'm going to build a wall, not one that Donald Trump wants to build between Mexico and the United States, but say down the middle of the United States, well, Americans would say, that's absolutely crazy. Why shouldn't California trade with New York? But when it comes to trade, people think there's something different. And if you talk to people in developed countries, what they say is different is the fact that wages are much lower in poorer countries, in developing countries, than in developed countries. So this is driving the fear of Americans about trading with Mexico. In fact, we had a debate in the United States, and there was a rich billionaire who was against free trade, and he said there's going to be a giant sucking sound. If we just open our trade with Mexico, all the jobs are going to go down to Mexico. But if you talk to people in developed countries, in developing countries, you'll find they also have a fear. Their fear isn't about wages. Their fear is basically about technology. How can you expect our SMEs, our small firms who don't have a lot of technology, to compete with those big multinational companies who've been doing all this stuff for years? These are at their core the fundamental reasons for fears about international trade. Well, it turns out that these kinds of factors, like the average wage level in a country or the average technology level in a country, are not what drive international trade. We've known since David Ricardo, famous British economist, that it is comparative advantage rather than an absolute advantage, either in technology or in wages, that drive international trade. So what exactly is comparative advantage? How can we explain Ricardo's insight? Many people have a lot of trouble understanding comparative advantage, and trying to explain it is very difficult. I've tried it with many people, and I find that you get into a very convoluted explanation. But then I found an explanation that actually works with my 90-year-old mother. So I figured, maybe it'll stand a chance. So let me ask you a question. Should Bill Gates paint his own house? How many people think Bill Gates should be painting his own house? And let's assume he doesn't derive any pleasure from painting his own house. Who thinks he should paint his own house? Nobody thinks he should. Huh? Is it expensive for Bill Gates to paint his own house? Please, somebody, tell me. Yes, why is it expensive? Time is valuable. Time is money, they say. And Bill's time is real money. Okay, so it's very expensive for Bill Gates to paint his own house. Now, there's something about Bill Gates you don't know. And that is, he's actually a very good house painter. What if Bill could paint his house twice as well as George? George is an average guy, and he went into painting. So now let me ask you, knowing that Bill Gates could paint his house in twice the time of George, should Bill Gates paint his own house? No. Most of you, well, I don't know what you think. How many of you think he should paint his house now? Nobody's changed their minds. Okay. Now we can ask a question about George. Should George develop his own software? If he's like you or me, how long would it take you to write Word? Or to write the DOS, or some other operating system? No, you'd say it could be very expensive. Think of all the time it would take poor George as he tries to write this program. In fact, he would be much better off doing something else with his time, because his time is also valuable to him. So we actually realized that it could be very expensive for Bill to paint his house, and it could be very expensive for George to try to develop software. But for Bill to develop software isn't that expensive, because the only thing he's sacrificing is the opportunity to paint his own house. Not as valuable. And similarly for George, what he's sacrificing what he would sacrifice would be the opportunity to develop software, and that would be very expensive for him. So when you look at this example, you can actually see the differences between comparative advantage and absolute advantage. On the one hand, when it comes to absolute advantage, who has the absolute advantage in software development? Who's absolutely better? Bill. Who's absolutely better at house painting? Bill. Bill is absolutely better. He can paint twice as well as George. So you see, there's an absolute advantage that he has in both. Poor George has an absolute disadvantage in both. But nonetheless, we can intuit how they could both gain from trade, because when it comes to comparative advantage, Bill has the comparative advantage in software development, and George has the comparative advantage in house painting. So the moral of this story is you need to specialize or to do the things in which you have a comparative advantage, and then exchange them for the things in which you have a comparative disadvantage. Again, you'll ask me, well, how do we know what we have a comparative advantages in? Let's hire McKinsey to do a study and to come and tell us, where's our comparative advantage? We don't know. Actually, we don't need McKinsey in this world, because what's going to tell us is actually the prices. The prices are going to signal where the country has the comparative advantage or not. If the price is relatively cheap when the country is isolated, that's going to be something in which it has a comparative advantage. If Sri Lanka were to be closed and we saw what the price of tea was, say, as compared with the price of automobiles, we'll see tea is relatively cheap. And if something is relatively cheap, we've already decided that's something you should be exporting. Conversely, if when you're isolated, automobiles are very expensive, that's something you should be importing. And exactly the same way, Bill's world, house painting is very expensive. That's something he should be importing. By contrast, software development is very cheap for Bill, and that's something he should be exporting. So this is the underlying theory. Now, there's something else that's very interesting, and it only emerges if we get some specific numbers. But let me give you a numerical illustration. Suppose that Bill and George both work full-time for a month. If Bill works in house painting, and then suppose Bill can produce 6 software programs or paint 2 houses, but George can only produce 1 program or paint 1 house. So, firstly, who has the better technology? Who has the technological advantage in this example? It's obviously Bill, because Bill is 6 times as productive as George when it comes to software development, and he's twice as productive when it comes to house painting. And if all Bill did was to produce programs, what you can see is his income, his wage would be high. By contrast, if George worked full-time, what you can see is if he worked for a month, his wage, his income would be low. He'd only have 1 program or 1 house. So this example which I gave you which seemed to be quite trivial on the one hand. On the other hand, it seemed obvious what each of them should do is precisely the example about which people are so fearful. Because in this example, one of them, Bill, has a superior technology in both activities. And the other one, George, has low wages, low income in anything he does. Indeed, his low income reflects his lower productivity. And yet, if we look at this example, we conclude the countries ought to specialize, at least the people ought to specialize, and they both can gain. As long as Bill can get his house painting done more cheaply than it would cost him to make it, he will gain. And as long as George can get software programs cheaper than it would cost him to develop it, he will gain. So both sides will gain as a result of trade. Now, as I've said, what the key thing is we can go, I'm not going to go through all these slides. You know, they say power corrupts and PowerPoint corrupts absolutely. And so I don't, I'll be happy to circulate these slides for you so you can get more detail. Now, you know, prices can be different in two countries. And we've already seen one thing that determines prices is supply. And actually, typically, supply will reflect the technological capabilities of a country, and sometimes it's endowments. Basically, you know, one reason tea is cheap in Sri Lanka is that you have particular, we went to see, you have particular climate, you have particular mountainous areas, and that's very favorable for growing the tea. So your endowments actually quite naturally lead you to specialize in those products. Saudi Arabia has a lot of oil, and that's why oil would be very cheap in Saudi Arabia if they were in autarky. That's one set of drivers. A second would be technology, your know-how. And then on the demand side, it will be influenced by your tastes and your incomes. But in fact, in addition to these two, your policies and your institutions will also affect prices when you are isolated and therefore also drive your comparative advantage. Many people who've studied international trade economics think that the only thing that drives trade is factor endowments. But in fact, what you can see here is that comparative advantage can be driven by a whole host of other factors. Okay. So I've so far spoken about all of the gains that could come when countries are different. But suppose that countries were the same. One of the strange things that we've seen over time is that similar countries have tended to also trade a lot with each other. And this whole economic theory which says you want to trade with countries that are different from you doesn't do very well explaining why countries that are similar will actually trade with each other. In fact, when products have similar prices in both countries. And only in the 1980s did economists really develop a framework which made more sense, but they had to tweak some of the assumptions they were using to think about trade. One of the key ones was, instead of assuming all products are the same, they recognized that products come in different varieties. And the second thing is that in order to produce varieties, many different varieties, it could be costly. There are, if you will, economies of scale. And in fact, this helps to explain why what we see is countries both exporting and importing the same kinds of products. The United States exports Ford automobiles to Germany, and Germany exports Mercedes-Benz to the United States. So we oversimplify if we think of products as standardized or homogeneous or all the same, but in fact, we need to take account of the fact that they are different. But it's costly to produce variety. You know, Henry Ford, he invented the Model T. But what Henry Ford said is, he says, any customer can have a car painted any color he wants as long as it is black. What was Ford saying? Well, in those days, it was very costly to paint cars different colors. And he could get scale economies only making black cars. So it is this combination that allows for trade even between similar countries. It also explains, by the way, why candy trades with Colombo. Why doesn't candy make everything itself? Why does it need to trade with Colombo? After all, you know, the people are the same, similar, the technology is the same, the factor endowments are the same, but they don't all, both cities don't try to make everything themselves. They gain from this kind of trade between similar types of cities in this case, precisely because candy can't make it all itself, because there are economies of scale. This is a very important type of trade. This basically explains, I'm not going to go through all this example, why countries often will export and import the same kinds of products. And this is especially trade that is important between countries that are similar, between countries that are in the same region. Think of trade between India and Sri Lanka. The people are quite similar. The income levels are quite similar. And it is very likely that if you produce a product that Sri Lankans like, you'll find Indians who are willing to buy that product. And likewise, if the Indians produce products, they will find that there are people in Sri Lanka who are willing to buy that product. But it's very important, therefore, that we understand that there are these potential gains based on being similar, and that we think about how we can encourage that type of trade. If on the one hand we have regulations, or we have people standing at the border and saying, well, even though the Indians would like to buy Sri Lankan tea, we're going to have a regulation that says it's not health reasons, or it's not safe, or needs to be produced in a certain way, it's going to interfere. And it's going to interfere especially with that type of trade. But this is a major reason why it makes sense for countries not only to try to trade with the world as a whole, but also to trade with countries that are similar with themselves. And it's also striking that if you invent something that appeals to consumers in one country, it's likely it's going to appeal to the consumers where in another country where the tastes are similar or where the income levels are similar. So all of these are reasons why we both see gains from international trade, trading with countries that are different, and we see gains from trade countries that are similar. I think I've probably gone on somewhat too long already, so I'm going to stop. But I do want to, I had a whole lot, something else planned, but I'm not going to talk about trade and firms. But I also want to note that so far what I've been talking about are rather static gains from trade. You know, we had a price, we had the ability to import that product, we had scale economies and variety, and then we got trade, and it could be in the same industry. But there are also very important gains that come a more dynamic form that come, for instance, from increased competition. Firms hate competition, but actually more competition can make the firms more innovative and can enhance their productivity, lead them to be more productive. They can also learn from one another. And that's a gain. If they're exposed, they say, you know, if you can make it in New York, you can make it anywhere. So you want to expose firms because those dynamic gains are another benefit. So to summarize what I've been arguing, there are gains from specialization, there are gains from scale economies, there are gains from product variety, there are gains from the product transfer of technology, increasing productivity, competition, innovation. All right, so you may say to me, well, if it's so good, how come people are so reluctant to open the economy? Isn't there some case and need to recognize that trade also has costs? And briefly, I want to identify 4 sets of costs. The first I've already alluded to. Trade may benefit the nation as a whole, but not everyone will gain automatically. Some may lose. And so we need to think about what mechanisms we might have if we want the gains to be more widely spread, to mechanisms that transfer from the winners to the losers. The second, and I'm going to explore this in the next hour, trade can only be guaranteed to give benefits to society if the initial prices are right, if the price signals are accurately reflecting the true social costs. You know, I went through that example of Bill Gates and George. And, okay, I went through the example of Bill Gates and George. And in that example, you know, it seemed obvious, you know, George should just keep painting houses and Bill should be developing software. I'm sure many of you are thinking, well, what is Sri Lanka? Are we going to be the house painters? Or are we going to be the software developers in this story? Well, if you want to make a case that what you ought to do is to encourage George to get into the software business, you first have to have a good reason to believe why the prices may be wrong to start off with. That today's price is not the long-run price. That in the short run it may be true that it's very expensive for George to develop software, but over time he may learn, and in one day he may actually be more productive than Bill in making software. That's basically the infant industry argument. That's the argument that says we don't only want to look at today's prices if we have very good reasons to believe that they are giving us the wrong signals. And I'm going to explore that, as I say, later on. A third dimension is that trade takes place within frameworks where the government has to set the rules, enforce property rights. If people dispute a transaction, then they need to be able to use the courts. We also need safety. You won't pay a lot for a good if you walk out of the market and someone steals it from you. So trade actually requires governance. And it's both true domestically and it's true internationally. And a lot of the disputes in international trade today are all about our system of governance. Who's setting the rules of the game? Who's defining the property rights in the international market? A classic case, of course, is intellectual property. Who says, you know, who should own a particular piece of intellectual property? Some countries didn't even used to enforce intellectual property. Others did. What should be the rules in the international marketplace? Some countries may have certain levels of labor standards. Others may have different levels of labor standards. What should be the labor standards in the international marketplace? Who should decide that? Increasingly, what trade agreements are all about and what the disputes are about are not necessarily the barriers at the border, like the tariffs and the quotas, but the rules of the game. Who is going to be defining those rules of the game and how are they going to be enforced? And maybe even if we're willing to trade with another country, we don't like the rules they want to impose on us, or they don't like the rules we would like to have govern our trade. So that's another set qualification that we have to add to this analysis. And then finally, we also need to take account that adjustment may be costly. That moving from what we would make if we were isolated to moving from what we would produce if we were specialized, well, that could involve unemployment, and that might be a reason, even if we want to move over the long run into free trade, while we might want to slow down some of the pace of the adjustment, or have special programs to help people adjust. Any questions on all of this? Just, again, you're utterly convinced. What's wrong with what I'm saying? Is there something that doesn't ring true to you? So as I say, please, because I don't just want to talk at you, I'd like to hear what you have responses.
Can I?
Yes, please, if you...
I just like to know restrictions at the beginning of the world. There was a barter system. What you're explaining is a barter system. What you produce better, you kind of swap, and that's how it. So if we didn't have borders, world was one country. You think the productivity of the world would be higher and it would be greater. So there'll be supply and demand, and that would be much greater.
Well,
potential?
The only thing I can tell you is if the prices were right throughout the world, I could be sure that opening up the world to a single market would make the world better off. But if there was a reason and why some of the prices were wrong, I can't say. I need to study the issue.
What do you mean by prices?
Okay, so let me give you an example. This is a preview of what I'm going to be talking about. Let's suppose that there's a country in which they don't regulate pollution. They produce steel very cheaply, but they don't have regulations that force the steel producers to take fully into account the social costs. Now, in isolation, that country may produce a certain amount of steel. But if we open up that country to the world, on the one hand, they will get benefits because now their steel is cheaper than in the rest of the world. But on the other hand, because they have failed to regulate the pollution, they could get hugely more pollution. The net result could be that the country itself is actually worse off. Even though it's gaining from trade, it's losing from pollution. Now, what's the answer? Well, the first best answer is to get its prices right. Let's regulate pollution. The country should make the polluter pay. If it did that, it might discover, actually, steel is not cheap in its country. The true cost of steel is actually much higher. So, that's why I wanted to be careful in answering your question. It is certainly a valid point that if we assume the governments have all been able to appropriately regulate so that the social costs are reflected in the prices, the world, will reach nirvana. The world will be doing as well as it can in allocating resources. But if the government doesn't regulate where it needs to regulate and deal with the market failures, the world could actually be worse off. Let me give you another example, sort of really relevant to the world in which we live. Think about borrowing and lending between countries, international capital markets and flows between countries. If you stand back, you say, this looks like a no-brainer. Why shouldn't we allow some countries to lend if they have surplus cash and other countries to borrow if they have more needs than they can meet through their domestic saving? So you ask me the question, would the world be better off if we had the free flow of capital around the world? At one level of abstraction, I'd say absolutely the world would be better off. But we also know, especially if the borrowers and the lenders are banks and financial institutions, it is very important that they be properly regulated. Because if we do not properly regulate those financial institutions, and we allow them freely to borrow and lend not only domestically but internationally, we could see financial crises. We could see that countries borrow too much. Those banks could borrow too much because no one is monitoring the costs that a collapse in a bank might make for the rest of their economy. So my answer would be potentially the whole world could be better off if we allowed for the free flow of capital for countries to borrow and lend, but only if we have the necessary regulations in place. And that is why, even though what many of you do here is vital, getting international trade, stimulating international trade has the potential to give you benefits. But to be sure you're going to get the benefits, globalizing needs to be accompanied by the right domestic regulatory frameworks. Otherwise, opening up to trade could actually be more damaging rather than less damaging. So trade offers the potential for these gains, but only if you've gotten your prices right. That's the central idea that I would convey. So I would say, both with respect to capital flows, especially because we've learned that financial institutions have to be regulated. There are risks that individual banks can inflict on the financial system as a whole. And under those circumstances, you need to be cautious and careful if you don't have the right regulations in place. And I would say the same holds true for trade. Yes, it has the potential to offer you great gains, but you need to make sure that the prices are right. And the regulatory frameworks are also in place. And so those of you in the trade area need to realize that you need to collaborate and cooperate with people from other agencies to make sure that you are working in harmony so that your social preferences are reflected in those prices. Other questions on this? Can we, yeah.
So you mean to say if the social cost is valued properly, then the free trade is ideal for the country?
Correct. That's what I would say. Then you could be more certain. But if it's not, if you simply open and you don't necessarily have those other things in place, you could be made worse off. On the other hand, you could actually be made even better off. So I don't want this to be used as an excuse not to trade. Let me explain. If we went back to my example of pollution, let's suppose this country doesn't regulate its steel industry. I gave you an example where the steel was cheap, the country exported the steel, and there was a lot of pollution. But suppose actually, even though it doesn't regulate pollution, steel is very expensive in the country, and it opens up to trade. Well, now the country is going to import more steel, and its domestic steel industry is going to shrink. In that case, the country is not only going to benefit from more trade, but it's going to benefit from cleaner air. So the gains from trade will actually be larger in the case when its prices are wrong than when its prices are right. So the moral of the story is we can make anyone who gives you these blanket arguments about the benefits of trade is implicitly assuming the prices accurately reflect social costs. Once you move away from that assumption, you need to study empirically. You need to look on a case-by-case basis to see, is this a change that could lead to even greater benefits because it's getting rid of some of the costs of production that you weren't taking into account? Or is it something that could lead to less benefits because it's going to impose some costs that you're not taking into account? But in both cases, and I just need to be clear because I may have misspoken earlier, in both cases, the first best solution is to get your prices right through using the regulations so that you accurately know what those social costs are. And by the way, what I'm going to develop, because you all have deserved a break for sitting so patiently, what I'm going to develop in the next lecture is thinking about this infant industry argument, because what I've already established is that must be based on an idea that for some reason the free market prices are wrong. And then it might be the case that you could benefit either from supporting an industry or protecting it. But we will explore that once we've had our break. So please, let's try to keep it. Okay, one. Great. Please. Sorry, just. Okay, I'm going to go another 10 minutes. So let's put the next lecture on, if someone can help me. But yes, I'm going to answer your question.
Yeah, in reality, there are many guys like George, right? I mean, Sri Lanka has to compete with many other guys like George. There's China, there's Bangladesh, there's India. So how does your framework explain the different strategies that each of these producers could pursue?
Well, I can still simplify my framework by asking, at the end of the day, if we have particular products, what are the price signals telling us? And it's us versus the world market. Now, you're right, in a lot of the product areas, the price in the world market is being determined by China and India and many other producers, just as George might find himself in competition with many other painters. Okay, but at the end of the day, what matters is that this is an area where the relative price for George is lower than other things he could do. You know, comparative advantage, it's hard to be absolutely better at something. I am a pretty bad golfer, but I'm an even worse tennis player. So I have a comparative advantage in golf, even though I'm not so good. And the thing that this insight of David Ricardo tells us is, I can benefit by specializing in playing golf. Okay. And likewise, even if your country is in competition with many other countries, at the end of the day, there are going to be price signals which will tell you what are the activities that are relatively profitable in your country. Now, you can say to me, no, I don't believe you. The prices won't signal that at all. And actually, there's a mechanism which will operate. If you can't sell anything in the rest of the world, and you find yourself running trade deficits as a result, you're buying a lot from the rest of the world, but your prices are no longer at a level where you are competitive, there will be a tendency for your exchange rate to weaken. And as your exchange rate weakens, what's going to happen is you're then going to discover that you are competitive in certain kinds of activities. So in the background of what I was presenting is a presumption that either the exchange rate or the wage level absolutely in the country is moving to the point where it allows you to balance your trade. So comparative advantage will allow you to rank your industries. You might be really super in, apparel, and this country really is. And then the next thing you're good at is tea. And then there may be some other activities which you could be good at a lower price, at a lower exchange rate. If you let the exchange rate move, what it's going to do is to allow you to compete in those different product areas with the Indias or with the other countries. And if you can't, your exchange rate will weaken until the whole adjustment process actually allows you to find those areas in which you can become competitive. So another one of the background policies that you really need to have in place in order to capitalize on international trade is an appropriately valued exchange rate. That's a key ingredient in finding the products in which you have a comparative advantage on a sustainable, and a competitive advantage on a sustainable basis. Okay, we're going to go to